Welcome back to the Everything Property Podcast. I have with me quantity surveyor, tax depreciation expert. We've had him on before. I call him the grandfather of tax depreciation schedules because he's been talking about it for so long. He's not old enough to have that title, and maybe I'll ruffle a couple of feathers, but he's back on the podcast. Mike Mortlock, thanks for jumping on.
You certainly ruffled my feathers. It was godfather last time, I'm pretty sure. Now I'm the grandfather. I don't know if I think I'm just getting older.
Aging a little bit. Yeah, you look similar to last time you're on.
Oh,
same suit as well. Look, what we want to do today is break down tax depreciation schedules from what they are, minimum requirements, who can claim, when they claim, all that sort of stuff. We're going to pack it into these podcasts so property investors that are looking to buy or have bought can get a great understanding in terms of why they need a QS on their team, when to engage one, how they can help in their property investment journey. So start us off if people are watching this podcast and have no idea what a tax depreciation schedule is.
Yeah.
Bring him up to speed, high level. What would be your quick little explainer on that?
Yeah, it's the allowance for the wear and tear of an income producing asset. So if you're a property investor, you're sort of like a small business owner. So the revenue of that business is the rent coming in, and of course there are expenses with every business. So your mortgage, the interest component on your mortgage is tax deductible, so that's an expense. Your property management fees, your repairs and maintenance, and depreciation is an on-paper expense as well. So by virtue of renting out a property, it's being worn out, and the ATO gives us kind of statutory rates of the rate of wearing out of all of these components. But at the end of the day, the job of a depreciation schedule is to help you as an investor to pay less tax.
Okay, perfect. Talk to me about how and when I engage with a quantity surveyor, and also I hear things, about the age of the property. There's pre and post a certain date. I know from our knowledge, and when you're on, we spoke about it, you actually have an opportunity to depreciate before a certain date, whereas a lot of the stuff that I see going out is that you can't. So just run us through when I'm talking to a quantity surveyor, and in terms of what type of properties that I can depreciate, and sort of around how the years and the type of property works.
Yeah, good. So any income producing property. So it can't be your principal place of residence. It has to be rented out. It could be your principal place of residence and you're renting out a bedroom, for example. That was the first investment property I ever had. I bought my own home and I rented out the front room.
Yeah.
So I depreciated a percentage of that. Of course, it exposed you to capital gains tax, so you need to speak to your accountant and get some professional advice.
Yep.
So it's any residential investment property or, commercial, industrial, agricultural, all sorts of things you can claim. When you should engage a quantity surveyor? Well, certainly after you've purchased a property. You can certainly get in touch with us to get an indicative idea about the potential deductions on a particular property, but I would make sure that people don't make that part of their decision, because depreciation, I always say, is a bonus, not a strategy. So if you've purchased a property, the best thing is to get in touch with us as soon as possible, just so we can have a look at what you've purchased, when you purchased it. Later on, you might make improvements. We don't necessarily need to see those improvements, because you'll have an item, a date and a cost, so there's no estimating required. You can give that to us to update the schedule, or give it to your accountant. Yeah, so in and around purchase is the best time to do it. Now, as for dates and qualifications, I came up with 3 triggers to tell you when a depreciation schedule would be worthwhile. Yep. The first trigger is the property is brand new. So if you buy a brand new property, you should get a depreciation schedule. Everyone kind of understands that, right? Because you'll be able to claim the original building structure. You'll also be able to claim the plant and equipment items within the property as well. So things
plant and equipment items, people are thinking it's not a factory, it's got no plant and equipment. What are you talking about, Mike?
Yeah, it's not an indoor pot plant.
Yeah.
And, I'm allergic to those.
Yeah.
It's essentially kind of loose-fitting items within the property, but that will include carpets, blinds, vinyl, ovens, cooktop, range hood, air conditioning, hot water system.
Talk to me about dates.
Yeah. So with these triggers.
Yep. Sorry, 3 triggers.
No,
Yep.
that's all right, but I'll tie it back in. The second thing is it's built after the 16th September 1987. So that's the cutoff date for depreciation claims on the original building structure.
Yep.
So if somebody says to me, I bought a place and it's built in 1990, I know straight away that it's going to be worthwhile for deductions, because let's say the structural component was worth 100K to build in 1990, you're getting 2.5% of that each financial year from 1990 for 40 years, so all the way to 2030. And 2.5% of 100,000 is $2,500 a year worth of deductions. That would be a worthwhile depreciation schedule. We like to see anything, in excess of $1,200 or $1,300 is definitely worthwhile in the first year of claim. Mm-hmm. So it's built. You bought it brand new, or you bought it a property built after 1987. Yep. The third trigger is it doesn't match 1 or 2. Not brand new, not built post 87. But what we're looking for is improvements to the property. So
Pre-87.
Pre-87, yep. Yeah. So the improvements won't be pre-87, they'll be post-87, yep. But I'm talking about a property that could have been built in the 50s or the 70s. It's had a kitchen bathroom renovation or an extension. We're looking for about 40 or 50 grand worth of construction works. Okay. Now, you don't have to be an estimating expert to look around a property and see that roughly that amount has been spent. If the whole thing has been renovated, then it's going to be likely worthwhile. And in 2017, when the legislation change happened, we analysed our database and we saw 69% were built after 87, and the ones that were built prior to 87, it was 64% of them had been renovated to an average value of about $39,000. Now that was pre-COVID, pre-massive construction boom. So what people should take away from that is that there isn't an arbitrary date where it's built before that it's not worthwhile. Mm-hmm. It depends on the history of the property, and most properties will be renovated. Most properties will have some sort of depreciation claim.
Okay, but if the property has been built pre-1987, say it's just had a coat of paint and new floors, you're saying that the renovation needs to be substantial to the tune of about 50, 60K for it to be worth your while to do a depreciation schedule.
We say 40, 50.
40, 50. And that would mean kitchen or bathrooms being done, or, there's significant walls or upgrades internally. If it's just a coat of paint and new floors, there's a good chance you're not going to be able to reach that amount.
That's true. And if that happens, that's part of our sort of due diligence when we first speak to a client. And, I had an email, a message on Facebook today saying, I'm not sure whether it's worthwhile, how do I tell? I said, send me the address and your email. I'll run some numbers for free. Mm-hmm. And I haven't done that as yet because I'm talking to you.
Yeah, prioritising, of course.
Exactly, yeah. But I will either say, yes, I think we're going to get between, say, $2,000 and $3,000 back. So in my view, it would be worthwhile. Or I'm going to say, look, this property is in pretty original condition, so I couldn't in good faith recommend you pay us X amount of money to get X plus Y back. That definitely does happen, but it's the minority of cases, because if you think about a property built prior to 1987, that's a long time ago now. That's probably before you were born, I'm guessing. By
definitely.
Substantial margin. That's the properties are pretty tired. It doesn't make sense to leave a property unrenovated at that age, because you could do a renovation, potentially get $2 for every dollar you're spending back, or you get a better quality of tenant, a better rental return, better results from a valuer coming in, so that you can perhaps pull some equity and buy something else. So most properties, certainly in capital city locations, are going to have had some sort of improvements over the years.
Okay, maybe an extension or something like that.
Those are gold.
And that's going to be the reason why we're looking at that 40K mark, because under that 40K mark, by the time you guys do your schedule and I do my claim back, what is it? I mean, what's an average depreciation schedule?
They're normally $600 or $700,
$600 bucks, and you're saying that I won't be able to even get that back on my claim, so it's not going to be worth my while. That's sort of the way about it. That's why.
And why we say 40 to 50 is because we need 40 of Division 43, so not the plant and equipment, the sort of structural components, and 40 grand at 2.5% is $1,000 a year worth of deductions. Yep. The report, let's say it's $600-700, that's tax deductible, so maybe it's $500. You're getting $1,000 worth of deductions at let's say you're on a 45% marginal rate. You're paying $500 to get $450 back. It doesn't stack, right? However, if you know you're going to rent it out for 10 years, then it is still beneficial. So some of our competitors will say, double our fee or we won't do it. We kind of say, if we come under double our fee, we'll give you the figures to your accountant and you can say, is it worthwhile paying X to get Y? Because it depends on your strategy. Now, that doesn't fit as nicely on a brochure.
Yeah.
but we want to have a collaborative relationship with the accountant to say, look, what's their strategy? Like they might have 2 years of back claim, in which case, $2,000 a back claim, $1,000 in the current financial year, that's $3,000. Suddenly the report makes sense. We don't want to ever push anyone into a situation to go ahead with the report, but if it stacks, then it makes sense for them to do it.
Okay, and talk to me about, I think an interesting thing to note with depreciation schedules is, okay, say if it was relatively new, it was post 1987, and I'm able to claim back an amount a year, it's $5,000. After 10 years, I then want to sell that property. If I've claimed back $5,000 every single year for 10 years, $50,000, what happens in terms of, can you explain cost base and selling that property and what happens there? Because a lot of people think it's free money, but don't understand what happens when they go to sell the property. Yeah,
it's a very, very good question. And it typically is a question that gets kind of heckled at me after presentations, because it's like, all right, Mr. Quantity Surveyor, that all sounds very nice for this free money, but what's the point of getting it if you have to pay it all back? The best way to think about this is that, let's say we get a property and, just for ease of round numbers, we buy it for $1 million and in 2 years' time we sell it for $2 million, right? So there's $1 million capital gain. Now, if over the course of those 2 years we claim $20,000 worth of depreciation deductions, and I'm talking structural deductions, not plant and equipment, then the cost base, which was your purchase price, it was $1 million, it's now $980,000. So in the eyes of the tax office, instead of making $1 million gain, you've made $1,020,000 gain, right? So it's kind of like, all right, well, I claim that and then I have to pay it back because it changes my cost base. But what actually happens is that if you hold the property for 12 months or more, you get a 50% CGT exemption. So that $1,020,000 is now half of that, right? So for ease of numbers, let's just say it's $500,000. And then it's only taxed at your marginal rate. So if you're on a 45% marginal rate, then it's kind of cut in half again. So you're never paying the full amount back. It's going to be much closer to a quarter of the expense. And then what you need to think about is the time value of money. We didn't tend to think about it a few years ago, but now with inflation so bloody rampant, we're talking about it all the time. Exactly. $1 today is worth a lot more than $1 tomorrow. When the $100 note came out, it was, of course, worth $100. But if you index it to that today, it's worth about $370, right? So there's an argument to say the buying power of $100 is now so rubbish that we probably should have a $370 note or a $400 note. I've even come up with ideas for people who would be on the front. The most popular suggestion is Aussie ostrich, I think. So $1 today is much more worthwhile getting it than down the track, especially if you're holding onto it for 10 or 20 years. The other thing to note is that the hardest time to hold an investment property is at the beginning, at day one, because over time you might pay down your principal. Let's say you don't, if it's just interest only. Over time your rent will go up. Again, this is a very topical thing. Rents have gone absolutely through the roof.
Yep.
So a negatively geared property day one will eventually become positively geared.
Yep.
You bloody hope, unless you're buying
with the rent increasing, interest rates as well, predicted probably they come down a few years, starts going like that, meets in the middle, and it turns over from negatively geared in terms of costing you money each week, in terms of paying you money each
exactly.
week. Yep.
So better to get those deductions at the time where your cash flow is hardest.
Yeah, definitely. Very good point. So the reason that I do the depreciation schedule is so I can get the money up front to help with that original cash flow in the first couple of years whilst I've bought the property. After that, the property price has gone up, the rent has gone up, so it starts to get into that neutral or positively geared territory.
The negative of claiming the depreciation is that your profit will be larger, so you actually will add that, or you'll subtract that from the cost base or add it to your profit. But then the reason why it doesn't stack as an argument for me is that you get that 50% CGT discount and then the marginal rate. So it's a fraction of what you're actually claiming back.
Yeah, see, people think talkers CGT's the next plague, but in most cases, if you can't mitigate it through the facility or the structure of what you've bought the property in, and you've held it for longer than a year, it's just the cost of doing business, right? So, all right, in that case, that $20,000 that I've claimed over the 5 years I've had gets added on, $1.2 million in terms of profit. If we were to work that out, then that would be, I get an exemption off half of it, so $600,000.
It's actually, it's 1.02 million, because 1.2 would be 200 grand. Yeah,
200 grand.
Yeah.
So 1.02, I would then need to pay
510,000. Yep.
510,000. Okay, perfect. And then of the second 510,000, because
marginal
rate on whatever my tax bracket is, because that's coming into my pocket.
Yeah.
Okay, that's perfect.
Yeah.
In terms of depreciation schedule and items within the house, what is the minimum amount of a plant and equipment item, for example, that I can claim back on tax versus as like an expense?
So do you mean sort of like repair and maintenance versus a depreciating asset?
Yes.
So repairs and maintenance is an important thing, and the ATO always talk about, every year they'll say, we're out to get the cash economy, or we're out to get tradies, or are you getting your stuff laundried? Then it better have a bloody logo. They always talk about repairs and maintenance for investors. Why repairs and maintenance is a hot topic is because it's normally an immediate deduction, right? So if you get someone to spend $500 repairing your hot water system, you can claim a $500 deduction in that financial year. Now, if somebody comes and they look at your hot water system and they say your hot water system's rubbish, you need a brand new one, you can't claim the costs of that new one as repairs and maintenance. It's actually a new asset that needs to be depreciated over its effective life. So that'd be 12 or 15 years, depending on whether it's electric or solar or gas. So that's important to get right.
If it's classed as a repair?
Yep. Repairs or maintenance, it's 100% deduction. If it's replacing an asset with another asset, then that's what a
repair could be, right?
Yeah. Well, it can be a very grey area, and there's all sorts of disputes that happen with the ATO and people.
Yeah, I have this because I had this over a hot water system.
Right.
This is what led me into the question. I had this with a hot water system, and my accountant had asked what was the purpose of the invoice from the plumber, and I said that was for a new hot water system, and he goes, unfortunately, that won't be an upfront expense. It will need to be depreciated.
It's sad. I feel sad for you because you're so excited to get that immediate deduction, but your accountant, unfortunately, is 100% correct.
Yep. Okay, perfect. So if it's replacing, is there a dollar amount on that replacement?
Not really, no.
Okay. It's not a $300.
What you're thinking about there is with plant and equipment items. Now, of course, to claim plant and equipment items, you either need to buy a brand new property with brand new assets in it, or you need to place a brand new asset in an old property. So if you put a ceiling fan in a property, if it costs $300 or less, you can get an 100% deduction on that.
Okay.
So, $300 or less is the plant and equipment maximum. Mm-hmm. And there's also some annoying rules that it can't be part of a set. So you can't buy, let's say, a dining table for your tenant and claim the chairs individually because it's kind of part of a set. Like it could be $200 chairs, but you have to add up.
What would you be claiming that as? That's not a cost, is it?
Yeah, you can claim that.
If it's furnished.
If it's a furnished property, you can claim it under freestanding furniture.
Okay, interesting. I think I've got my head around it now. Do you have any sort of tips and tricks in terms of tricks being all above board to the ATO members and everyone watching? Tips and tricks for sort of investors in terms of depreciation schedules and anything like that you pick up or that you recommend to clients? Not taking too much of your IP away from your business.
No, that's all right.
Just like some little tips and tricks to add in there.
I think the most important thing at the moment is to make sure that an inspection is undertaken on your property. There's a few operators out there that are saying that it can be done as a remote thing. The Australian Institute of Quantity Surveyors have issued a white paper to say these are best practice, and you can only really do a report without an inspection if it's a brand new property where the exact construction costs are known. So let's say a brand new house that you build, and you'll need plans and finishes as well. But even in that example, it might say stainless steel appliances, but there's a big difference between Technica and Gaggenau, right? Around about $25,000 in an oven, right? Or carpet to living areas. Well, is that the hallway as well? Like, it's difficult to tell. So that's an important one. The other thing is just to make sure that they are going and checking to see whether a depreciation is worthwhile. I don't know any quantity surveyor that's going to charge you a fee to give you an idea about whether it's worthwhile or not.
Really?
So, yeah, I'm pretty sure everyone, well, we do it for free, right?
Wow. A little cheeky little business
bit of a
plug.
Yeah, whoever it is I work for, come and see us.
Wow, yep. Check the show notes. I'll link everything
notes.
in there, definitely.
Yeah, look, and I'm so passionate about people claiming their entitlements. I often say to people, I don't care whether you use us, just use somebody. I think my employees would like us to be chosen because it helps to keep them employed, and they're all very passionate about what we do. Of course, we would love the business, right? Yeah. But I'm just sort of trying to shock people into the point where, like, I'm not selling something that's not a good fit for you. I'm saying that this is so important that, like, if you're uncomfortable with the way that we operate, use somebody else.
Mm-hmm. But it's out there. It's out there for people to know. Can you explain for me as well the difference between plant and equipment and then the second item, structure and the built form? Yeah. How does that actually work? So plant and equipment, we touched into it. If it's under $300, you can get the write-off. If it's over $300 and it can't be part of a set, then you need a depreciation schedule for. But what about like structural items and all the other stuff that's not plant and equipment? Yeah, so there's I like to call two buckets of depreciation, and the names come from the Income Tax Assessment Act of 1997. This is why I'm so popular at barbecues, this sort of knowledge, right? People invite me to parties all the time. Yeah, definitely.
Yeah. So it's Division 40 or a Division 43. So Division 40 is plant and equipment items. So that's loosely defined as things that can be removed from the property without damage. The other component, and that's where the vast majority of the value is the structural stuff. So that's just easy things like timber, like concrete, like gyprock, like tiling, like cabinetry, like whatever the hell your roof is made of, right? Okay. So that's very easy to calculate. So of course we need to estimate the value of what you've got there when you purchased a property. Let's say it's 10 years old. We estimate the cost to build the property at 10 years ago. Okay. And for that structural component, it's just an easy 2.5% depreciation claim each financial year for 40 years from the date of construction. So 2.5% on the estimated value that you think it was back in, and I'm sure you've got like charts or like rules of thumb in terms of dartboards, everything. We've got a whole setup. Table tennis. But are you guys doing like a takeoff in terms of the area and the size, the amount that's there? Yeah, it's not as sophisticated as, say, an indicative elemental estimate or a detailed measure that we would do in the construction side of our business. But of course, we need to measure the property because the size of the property matters from a construction cost, and then the standard of finish, what type of site it's on can affect construction costs. So everything that you understand about what would make a property more expensive than another one, site conditions, the standard of finish, how big it is, whether it's single floor, double floor, these are all factors that come into estimating the construction costs, all the way to regional indices as well, because the cost to build, say, something in Brisbane is going to be different to something to build in Cairns because shortage of labour, material movement costs, all sorts of things like that. Okay, that's incredibly interesting. Do you think a QS can do that without visiting the property? No.
Okay. Is there players that'll try to do like a desktop assessment if they've got plans and photos?
Yeah, we will do a desktop assessment to get someone to decide whether they should get a report done or not. But you can't rely on it. It's just us going, okay, yep, I think this one's definitely going to stack for you, and then we go and we do.
So you guys are visiting every single property.
Yeah, we've got inspectors all around the country.
Okay, so that's what will be my next question. If I've got a property up in Cairns, you guys would send someone out to go up and visit that.
Yep. I got one in Cairns as well, so it's a good chance for me to go and have a look.
Okay. I didn't know this, so that is incredibly. That's interesting. So you guys will actually go visit, do like a take off photos. Do you need plans or anything?
Most of the time, we don't have plans available, so we'll take measurements of the property because we need to know how many square meters of wet areas there are, square meters of carpets and blinds and those sorts of things.
Okay, and for those everything that's not plant, that's depreciating for 2.5% for 10 years?
40 years.
40 years.
Yep.
Okay, perfect. What else have we missed, or that we sort of need to talk about? Well, what are some? I've got down in some notes.
Tips.
What to avoid?
Tips.
Give us tips. Also, what to avoid. I'm sure you see it a million times with rookie investors, but one of the things you covered was literally just not getting this done and waiting too long. In that case when you're on a few weeks ago. But tips or things to avoid. Anything else that you can add?
I'll give you two things. One, I saw a post from a buyer's agent in Brisbane, and it was a bathroom that was carpeted. And that was kind of gross, right? Because every now and then you go to the toilet. I mean, even though I'm an estimator, sometimes I get the distance wrong. But I said, look, I actually think this is brilliant. Finally, people have been listening to me, because if you're putting, say, a new floor covering in your investment property, carpet has an effective life of 8 years, whereas tiles has an effective life of 40 years. So the difference in the depreciation rate is actually 10 times. So it's 10 times better to put carpet in than tiles. So I go so far as to say, look, tile your bathroom, tile your kitchen. Like, it's ridiculous. Like, you probably shouldn't be doing that.
You're saying it's better to do the tiles?
Sorry, carpet your bathroom, carpet your kitchen, carpet your walls, So that's, I think, an interesting thing for people that are looking at renovating, right? So if you're putting brand new assets in a property, by changing the things that you pick, you can actually front load those deductions. So let's say you're spending $5,000 on carpet or $5,000 on tile. With a tile, you're taking really 40 years to get your money back. Whereas the carpet, it has an 8-year effective life. It will depreciate over a slightly longer time. That's a mathematical nuance, but the value is really going to be gone after 10 years, right, compared to 40 years. So by strategically thinking about the assets that you place in a property, you can actually alter your tax position.
Okay, but if I'm putting it like for an investment, for example, though, if I'm carpeting instead of tiling, the longevity of, obviously, as you said, but like carpet's not going to last as long. It's going to stink. It's not going to be as easy to clean. So it's a little bit of a.
You're not convinced, are you?
No. It's a great thing to think of, but I don't know if it would still make me carpet.
No,
choose carpet.
It was certainly not in the bathroom or the kitchen, right? But if you're indifferent about it, so if you're kind of thinking one or the other, it's just important to know that carpet will give you a better result. A better example, or something that's maybe a little bit more real world, is plantation shutters are considered structural items, whereas blinds and curtains aren't.
Plantation being the ones that
those timber sort of louvery things.
Expensive.
Yeah, they are very expensive. So that's a consideration as well.
So they're counted as structure instead of
plant equipment. Yeah.
And what's going to be the depreciation factors?
It's going to be 2.5% if it's plantation shutters.
Yep.
And there is something called a low cost or a low value pooling schedule. So you're able to depreciate your blinds as individual rather than part of a set. So it's 18.75% in the year of acquisition and then 37.5% each year thereafter. So it's a way higher depreciation
37.5%. 37.5% per year?
Yes.
How does that work?
Well, the first year, it's 18.75% of whatever you spend.
Yep.
And then the second year, it would be 37.5% of the remainder. So if it was 5,000... you'd lose a bit in year one.
I'm thinking of the total value. So I'm like, what happens after year 5 when you've claimed the total amount back? But
yeah, you can't claim more than what it costs.
Yeah, okay.
But it's just front loading those deductions.
Is there anything in terms of plant and equipment that you have similar, or it's just the same based off the cost?
What do you mean similar?
Would there be any examples where it's better to put a cheaper or more expensive plant or equipment item in for depreciation, or it doesn't really?
Well, depreciation is one of those weird things where it kind of flies in the face of some conventional wisdom. Like if someone says, I bought a property and I've overcapitalized it, I'm like, yay, we're going to get some great deductions. But, their financial advisor might be like, oh, that was a waste of money. Like you're not going to get that back. So it's very different. And when I say, okay, this property is going to have great deductions, it might not be a great investment property, right? That's, I've done an estimate on a property this is quite some time ago. It was an $8 million property in Sydney and it had 0 depreciation deductions. So there are quantity surveyors that sometimes will say, like, normally you can claim, say, 60% of your purchase price as depreciation. Well, how does that work on this particular one? It was kind of like a mansion that was abandoned, right? So really they were buying land value. So an $8 million purchase, which I was so far away that this is probably a $15 million, maybe a $20 million purchase now, and it actually had 0 depreciation deductions. And there's all sorts of weird nuances, like let's say 2 apartments, same floor of a building, a hallway intersecting. One has a view of the harbour, the other one has a view of a car park. One could be double the price of the other, but they're absolutely identical. Mm-hmm. So when you say you can get X amount of the purchase price of depreciation, it doesn't work because a view has no depreciable value, right? Mm-hmm. Land has no depreciable value. So there's all sorts of weird nuances about the space. I'll give you one more tip if we've got time.
I think last tip, I was going to ask you for your golden nuggets. So one piece of information that everyone can sort of take away. So this will be it, but please.
If you buy a property that is strata titled, and it doesn't have to just be a high-rise complex, although those can be great for deductions, even, say, a townhouse, it may have a common driveway, there might be a swimming pool, there could be some solar lights if it's brand new. You're actually owning a percentage of that. So if there's, say, 10 units in the block and there's a common driveway, you're going to get roughly 10% of the value of those common areas as well. So that's something that not a lot of people realise, is that when you're buying into that complex, you are taking a percentage of ownership of that.
Okay, and is your responsibility as a unit owner to get that, or does like the body corp do like a depreciation schedule and then circulate it?
No, they won't. They'll do an insurance replacement cost, they'll do a sinking fund, but they won't do a depreciation schedule on the premises. Okay, it'll be your responsibility.
So when you're buying in a strata, if it's not, Torrance title, when it's strata titled, you're buying into also be able to depreciate a portion of the facilities, amenities, and what's in and around that building.
Yeah.
Interesting one to note. I never knew that.
There you go.
Well, we'll end on that note because I like learning stuff. Look, Mike, thanks for coming on again. As usual, incredibly nice and soothing radio voice from all your years podcasting. I wish you all the best, and I can't wait to get you on again to talk about some other items. But yeah, appreciate you coming out, your time and your knowledge for myself, and obviously for all the listeners too.
Thanks for the invite. It's been a pleasure.
No problems.